When you're trying to solve a complicated problem, you have a better shot of finding the solution when you start asking the right questions. And your retirement basically boils down to one big question. Is your money going to outlive you, or are you going to outlive your money? Do you have enough money to last through retirement? It sounds like a guessing game because no one can predict with absolute certainty what their future holds. But you can take a measure of far greater control than you probably realize by understanding the relationship between two critical factors, inflation and longevity. You're probably going to live a long time, longer than you think. And because of inflation, your lifestyle costs are going to be double to triple what they are today in the next 20 to 30 years. The variables in the retirement equation have changed, and the conventional approach to retirement, the one that worked for your parents, won't stand a chance going forward. I'm Justin Stevens, a certified financial planner, entrepreneur, investor, and co-founder of O'Keefe Stevens Advisory. My team spent more than 20,000 hours researching the best ways to approach retirement planning for the clients we serve. We work side by side with successful engineers, professionals, and business leaders who are comfortable with taking a long-term perspective, working with proven formulas backed by research, and who understand how to monitor their financial situation with focus. First, let's talk about you. Up to this point, you've probably built your wealth by living within your means, seeking out good deals and bargains, and not stretching your finances to keep up a certain image. Because of that discipline, you've built assets of considerable value. Yet many of you are careening toward retirement without a date-specific, dollar-specific plan for how you'll accomplish the largest financial transition of your life. If it's any consolation, you're not alone. According to a 2014 report by the Employee Benefit Research Institute, many of us are in fact very likely to run out of money. At lower income levels, this problem will be far worse. But even in the upper income quartile, 13% of baby boomers will run out of money during their lifetime. So you see, at every income level, people are at risk of running out of money. As I said before, I believe the retirement solution that worked for your parents is broken, and it won't work for you today. Let's talk about how we fix it for you, the modern day retiree. Over the past 30 years, average life expectancy has increased by about 15 years, and advances in medicine are pushing those numbers further every day. Today, the average 65-year-old is expected to be around for another 20 years. That means most people are expected to live to 85 or older. Today's retiree has very different options for funding their retirement than the retirees of the early 1990s. For instance, 30 years ago, the 30-year Treasury bill paid an 8% yield. That meant a $1 million investment in Treasury bonds would have produced an income of $80,000 a year for 30 years. Today, that same Treasury investment pays about 3%. And if we have a situation where interest rates recover to where they were 30 years ago, investors in these historically safe investments are going to be in big trouble. I can't stress this point enough. Bonds, CDs, and other fixed income investments are all susceptible to the inverse relationship between interest rates and the price of the investment. That means if interest rates rise, the price of fixed income investments will drop. Today, our interest rates are so low they can't feasibly drop much further and are almost certain to increase during the next 2 decades. Yet despite the grim prospects, taxable bond funds have attracted more money than any other registered product category in 7 of the last 10 years. That proves my point that investors, and many of their advisors, are working off an old model for retirement planning. It's based on the outdated wisdom that as you age, you should be moving more and more of your money towards fixed income assets. So here's where we are. 1. You're going to live a lot longer than previous generations of retirees. 2. The old method of selecting fixed, stable investments is broken because of the decline in interest rates. And therefore, 3. Today's reality requires a different way of looking at retirement and a solution that matches today's environment. Given these 3 points, where's your risk? It's here. Inflation. Without a plan to increase your income stream for the next 20 or 30 years, you might run into the problem of spending down your money. You know what inflation is, but you may not understand how it can impact you over the long term. Let me explain. Do you know what the price of a stamp was in the year you were born? Probably not unless you're a stamp collector. Let's just say you were born in 1954. A stamp cost 3 cents. By 1984, that same stamp cost 20 cents. And 35 years later, in 2019, a stamp costs 55 cents. Looking at 1984 to 2019, the cost of a stamp increased by 275%. You see, having an income that is fixed over long periods of time wreaks havoc on the purchasing power of your hard-earned dollars. That's inflation. Inflation is the #1 risk you're facing, and if you can solve for this risk, you're going to be a lot better off than most people. The logical conclusion here is you need your income to grow, because a decline in purchasing power driven by inflation will require you to spend more of your dollars to buy the same things, whether that's stamps, new cars, or dinners at your favorite restaurant. So here's how to address inflation. First, your retirement investments need to produce a rising stream of income for the rest of your life. Second, to do this, you should not plan to spend down your principal, but aim to keep building the nest egg you've already developed. And third, you might not have realized it yet, but when you're old and gray, you're going to really appreciate having built a sizable legacy to support your loved ones, or even your community, because it's powerful proof that you haven't lost your financial independence. That's what you want, and I hope I'm helping you to see how to achieve that more clearly. Here's the catch though. The statistics I've been showing you so far in this presentation talk about the averages and apply to average people. Average people are not the types of people who watch an educational video like this. In fact, the link between education and longevity is undeniable. The people we work with are likely to live much longer than the averages. If you're above average from an educational perspective, it's probably a good idea to ditch those averages and address your potential longevity with a financial strategy that leaves you with plenty of room for surpassing the average. That means you need to be positioning yourself with a strategy that creates rising income and continues to build wealth, because you'll need that to carry you through a 20 to 30-year retirement. Let me show you why. When you visualize your retirement income needs on a graph over time, it looks something like this. I divide this line into 3 phases of retirement: the go-go years, the slow-go years, and the no-go years. In those first go-go years, you'll want to do fun things like take your grandkids to Disney, go on a riverboat tour through Europe, or maybe spend a few months in a warmer climate while you keep your roots in your hometown to be close to family and friends. So it's unlikely your expenses will decrease in the initial phase of retirement. But eventually, things settle into a nice rhythm, spending levels off during those slow-go years. And finally, there's the no-go years, hopefully the shortest part of your life, when healthcare costs increase rapidly. If this phase of retirement spans many years, it can be the financial unwinding of your family's wealth. In order to accommodate this kind of expense growth over time, you need a strategy to grow your income. And that looks something like this. But what most people sign up for is this. And what happens during the gap years is you start spending down principal. And I'm telling you, this is a fatal mistake if you're going to live a long life. It leaves you in the position of hoping you die before your savings reach zero. What I'm telling you is income growth matters most. Let me show you what happens in real life. Most people come to us with retirement income split some way between 4 sources: Social Security, maybe an annuity or pension, and perhaps some employment income. The 4th source is income from their investments. Work is usually not an enduring source. Pensions generally remain fixed in place, and Social Security is designed to grow at the same rate as inflation. Over time, here's what happens. In 10 years, a $100,000 income inflated at 3% grows to $134,000. Social Security is likely maintained, the pension stays constant, and work might be gone. The investment income now represents a much higher percentage of the income pie. If investment income once accounted for 50% and is now 65%, and the total income need grew by 34%, $50,000 of investment income needed to grow to $87,000 over 10 years. That's a 75% increase, or nearly 6% annual increases. And in this example, you're just keeping up with rising costs. There is only one asset class available to everyone that has reliably grown income at this pace. It's stocks, specifically their dividends. The growth of the cash dividend from the S&P 500 index has doubled the rate of increase of the Consumer Price Index since 1960. And outpacing inflation is the only safe way to protect yourself from the rising cost of living. Dividends are the answer. Also, stocks have the benefit of growing your wealth when held for longer periods of time. Even during the last 20 years, which included 2 major market corrections, stocks have grown wealth far faster than fixed investments. The only reliable grower of your income also has the added benefit of growing your wealth over the long haul. The obvious question is, what about volatility? The short answer is, over a long enough period of time, it just doesn't matter. But here's how we manage it in the short run. We use a capacitor. Let me explain. Take yourself back to elementary school when you learned about electricity in science class. Even at an elementary level, you were taught about the oscillations in an electrical current. What happens when you try to run a light bulb using a volatile oscillating current? Well, it flickers because it's getting too much power at the peaks and not enough at the troughs. To fix that, you need a capacitor. The job of the capacitor is to store and retain the surplus energy from the peaks, so when you turn on the light bulb, you get consistent and reliable output. Why am I telling you this? It's an analogy for how we manage stock investments in a retirement portfolio. Like electrical current, we know stocks produce a positive charge over time, but the inconsistency of stocks in the short run results in income fluctuations linked directly to the value of the portfolio, unless you use a capacitor. Cash reserves set aside to cover 1 to 3 years of income needs are the capacitor used to mitigate the volatility of your stock portfolio and give you the ability to draw consistent, reliable income. And it works the same way as electricity. We pull from the stocks to replenish the reserve at the peaks, and we spend the reserves at the troughs. When done correctly, this strategy positions the bulk of your wealth in assets that create increasing income year over year. What I see, and what the research shows, is volatility is a scary thing for nearly all investors. Most people aren't properly hardwired to handle it alone. Plain and simple, behavior gets in the way of our success. You now understand the importance of planning for longevity, investing for continued income growth. Now let's talk about your behavior. The single most important variable for your retirement investment success is also the only variable you ultimately control: your own behavior. Things like managing panic and having the discipline to stick with your well-defined strategies. We've built a framework for behavioral guidance and an investment process that aligns your portfolio to address the exact risks I've been telling you about. And what I'm an expert at is facilitating a conversation about what matters to you and what you can control. The intersection of these two circles is where we spend our time. What matters is family, occupation, and recreational aspirations. Money is the how. We never lose sight of these things while we discuss your money. The things we can control are planning, process, and philosophy. This is different than other advisors who focus on products, pricing, and performance. You're going to live a lot longer than previous generations of retirees. The old method of selecting fixed, stable investments is broken because of the decline in interest rates. Today's reality requires a different way of looking at retirement and a solution that matches today's environment. Your retirement investments need to produce a rising stream of income for the rest of your life. To do this, you should not plan to spend down your principal, but aim to keep building the nest egg you've already developed. When you're old and gray, you're going to really appreciate having built a sizable legacy to support your loved ones, or even your community, because it's powerful proof that you haven't lost your financial independence. As a financial advisor, I can help you implement this strategy and monitor it with a focus most people don't have when they're enjoying those go-go years of retirement. So now it's up to you. Would you like help? Or would you like to take everything you've learned and implement this on your own? If you'd like our help, here's what you need to do next. There's a link below to set up a discovery call. This call will take 30 to 60 minutes of your time, and we will take a look at exactly what you have, your goals and objectives, and provide additional clarity if we discover that we can help you. If what I've explained makes sense, click the link below. When you click the link, you'll be directed to my calendar. You can pick a time for us to talk and determine if working together would be a good fit. As a way of saying thank you, and to guarantee your time is not wasted, I'll also send you a copy of Simple Wealth, Inevitable Wealth. You've already made an incredible investment just by taking the time to learn about this important topic. Thank you. I look forward to speaking with you soon.